Welcome back, guys. So today we're going to be talking about a top secret, insiders only tip that can help you pay off your 30-year mortgage in only 5 to 7 years and become completely debt-free. Now, this is the secret that the multi-trillion-dollar banking industry doesn't want you to know about it. So make sure you listen all the way to the end as we walk through this step by step. Now, if being debt-free and mortgage-free in only 5 to 7 years sounds too good to be true, well, that's because it is. It doesn't work. Velocity banking is a scam. Hi everyone, my name's Ben, and this channel is dedicated to all things personal finance related, helping you earn more, spend less, and invest the difference the right way. Now, if you're someone that's watched a lot of financial videos online, chances are you've probably ran across somebody advocating this velocity banking strategy. So if the strategy doesn't work, then why do so many people make videos about it? Well, there's sort of two reasons about why this phenomenon is still going on. And the first one is that YouTubers have sort of an incentive to generate clickbait material. They get paid by the number of viewers that end up watching their video. So the easiest way to get a lot of views is to make some sort of outrageous claim or statement, like being able to pay off your mortgage in only 5 years as opposed to 30 years. That gets a lot of people interested and it gets a lot of views for that particular video, and so the YouTuber makes a lot of money. And the second reason that this phenomenon keeps on happening is the strategy itself is so overly and needlessly complicated that the viewers just don't know what's going on. They lose track of where money is coming from and where it's going. And to be honest, most people just suck at math to begin with. So with all of these moving parts, they fail to realize that fundamentally, this whole structure is flawed and doesn't work. But since they don't realize that the whole system is trash, they just think this YouTuber is a genius, they subscribe and they watch more of his videos. In fact, I just recently watched a video last night from a gentleman who has close to 250,000 subscribers. This guy makes hundreds of thousands of dollars a year on YouTube. And so with a following that large, you're sort of seen as an authority figure and that whatever you're saying is true, even when it's not. So what is this velocity banking that they're all talking about? Well, I'm going to overly simplify it for the sake of this video, but essentially what they're talking about is, let's say that you go out and you buy a $200,000 house and you put down 20% down payment. So you owe $160,000 on a house that's worth $200,000. Now what they're advocating is you go and then immediately get a second mortgage, a HELOC, a home equity line of credit, to tap into that $40,000 worth of down payment that you had. Now you can't access all of it, but maybe you can get a second loan for about $25,000. So you're going to take out a second mortgage against your house for $25,000 and then immediately use that $25,000 to pay down your mortgage. So now instead of owing $160,000 on your mortgage, you owe $135,000 on your mortgage and $25,000 on your HELOC. And then you're going to pay this HELOC down as rapidly as possible, and then once that's paid off, you're going to chunk again and take out another $25,000 HELOC and once again apply it to your mortgage. And some of the reasons that they typically give of why you would want to do this is that due to the amortization schedule being front-loaded with interest, by chunking and suddenly making these massive payments towards your mortgage, you are skipping ahead in the amortization schedule where you are then paying less money in interest. But things get even more complicated because then they advocate that you basically need to use your HELOC as a checking account. So instead of having a checking account, you're having all of your money direct deposited from your job directly into your HELOC to pay that off as rapidly as possible. and it's just sort of taking money from one account and moving it into another account. It's sort of like the classic shell game, and eventually it becomes very difficult to keep track of what money is going where and why and what the interest rate is. And it's just too confusing for the average user, and so they get confused and they lose track of the overall picture that it's all a scam. I mean, look, the banking industry is a multi-trillion-dollar industry. If there was some super top secret method to pay off a 30-year loan in only 5 to 7 years, then it wouldn't be a secret. It would just be the way that literally everybody bought and sold real estate, and the way that everybody paid off every single loan they've ever had. It wouldn't be a secret, it would just be common practice. But for those of you guys out there that still don't believe me and you think this method works, for fun, let's just break out a calculator real fast. So in this example, if you bought a $200,000 house and you put down a 20% down payment, so you owe $160,000, excluding your taxes and insurance, the principal and interest contribution for your mortgage would be about $745 per year at about 3.8% interest. But let's just assume for fun that we're literally paying zero interest. We have found a magical loophole with this HELOC process to just eliminate interest payments altogether, so that 100% of that $745 payment is going towards our principal and not towards principal plus interest. So if you multiply $745 per month for 12 months for the year, multiplied by, let's just say, 7 years as that 5 to 7 year loan payoff, we get a grand total of $62,000 that we've paid towards this loan. Except we owed $160,000, so we're only about 40% of the way there in paying off our loan in 7 years by paying absolutely zero interest. So as you can see, obviously the method doesn't work. It's physically impossible, no matter what your interest rate is, to pay off a mortgage in 7 years. The only way that you can speed up and pay off a loan faster, there's 2 ways it can be done. You can lower the interest rate that you're being charged, therefore more of your money is going towards principal pay down as opposed to interest payments. Or you can just pay additional money more than the minimum required. So instead of paying $745 a month, maybe you pay $1,000 a month, or $2,000 a month, $3,000 a month. Now, it's obviously no secret that the more money you pay towards a loan, the faster the loan is going to get paid off. And that's the whole secret behind Velocity Banking. It's not the HELOC that makes life easier for you. It's not compound versus simple interest. It has nothing to do with amortization schedules. The only thing that's helping you pay off a loan faster using this Velocity Banking technique is that you are making significantly larger mortgage payments than you would have otherwise been making. But it's so complicated and convoluted that you don't even realize you're making these big payments. These gurus advocate taking out something like a $25,000 HELOC and putting that towards your mortgage and then quickly paying off this HELOC in 6 months and then doing it all over again. Well, the problem is, during this whole 6 months, not only are you still paying the mortgage on your house, so you're still paying as much as you would have otherwise because you still have this mortgage payment, but you're also somehow coming up with enough money to pay off an extra $25,000 HELOC every 6 months. So you're paying $25,000 more towards your house every 6 months, and that's how your mortgage is getting paid down. In fact, the HELOC is universally hurting you. A HELOC is a second mortgage, and as a second mortgage, it is a riskier loan for the lender. And since the loan is riskier, they're going to charge a higher interest rate than your primary mortgage. So right now you might be able to get a mortgage in, give or take, a 3% interest rate category, but your HELOC might be somewhere closer to 5%. So by taking this $25,000 and putting it into your HELOC as opposed to your mortgage, you're trading a 3% interest rate for a 5% interest rate. You are willingly choosing to pay 2% higher interest. There's no reason for that. Obviously, if you are paying a higher interest rate, then less of that money is going towards your principal payments and more is going towards the interest. So this HELOC is universally slowing you down. If you are wealthy enough that you could pay down an extra $25,000 every 6 months, then skip the HELOC entirely and just put the $25,000 towards your mortgage. And that would dramatically speed up your process, and it would be infinitely easier and less complicated and less stressful than trying to set up this velocity banking strategy. Now, I know this video was sort of a rant, but I think it's very important based on the number of views that these other channels are getting, because they're giving out bad advice. It's very important that you go and actively seek financial knowledge, but it's equally important that you get this knowledge from someone that has your best interest at heart and is actually giving you true, legitimate information. If you found this video useful, be sure to subscribe, leave a comment down below. I love hearing from you guys. I have new content every week, and as always, I'll see you all again next time. Thanks.